Stock market dividends. Good morning, everyone. Welcome to our deep dive into one of the most fundamental yet often misunderstood aspects of stock market investing, the corporate dividend. Today, we are moving beyond the basics to explore the technical mechanics, the critical dates, and the key financial metrics every serious investor needs to master. Let's begin. Defining the dividend. At its core, a dividend is a distribution of corporate profit. It is simply a portion of a company's net earnings that the board of directors chooses to return to the shareholders, rather than reinvesting in the business. Crucially, this reward is allocated strictly on a per-share basis, meaning your total payment is directly tied to your ownership stake. The source: retained earnings. From an accounting perspective, dividends are highly distinct. They are not an operating expense. Instead, they are paid directly out of the company's retained earnings, the cumulative profit amassed over time. When a dividend is paid, it reduces the equity portion of the balance sheet. Consequently, it's recorded on the statement of cash flows as a cash outflow in the financing section. The dividend timeline. Overview. The process of paying a dividend involves 4 immutable dates that dictate investor eligibility. They are the declaration date, the ex-dividend date, the record date, and finally, the payment date. While all are important, we'll see shortly that the ex-dividend date is the single most critical checkpoint for investors acquiring shares. Phase 1. Declaration date. The process officially kicks off with the declaration date, where the board of directors formally announces the intention to pay, specifying the amount per share, and setting the subsequent dates. On this date, the company immediately recognizes a debt, booking a current liability on the balance sheet known as dividends payable. Ex-dividend date. The ex-dividend date is the investor's cutoff. Due to stock settlement rules, if you purchase stock on or after this specific date, you are purchasing it, ex, or, without, the right to receive the forthcoming dividend. This date is so powerful that, typically, the stock price will adjust downward by the exact dividend amount at market open, reflecting the value that has left the company's treasury. Record and payment mechanics. Following the ex-date, we have the record date, where the company checks its official register to confirm all eligible shareholders. Finally, on the payment date, the cash is transferred electronically to the investor's brokerage accounts. This action eliminates the dividends payable liability from the balance sheet, completing the cycle. Cash versus stock dividends. While most dividends are paid in cash, a company can also issue a stock dividend. Cash dividends provide immediate, tangible liquidity. Stock dividends, on the other hand, are paid in additional shares. This is often done to conserve cash while still rewarding shareholders, though it results in a slight dilution of existing shares. Technical metric: dividend yield. For the technical enthusiast, 2 metrics are paramount. First, the dividend yield. This measures the return on your investment solely from the dividend income, calculated as the annual dividend per share divided by the current market price. While a high yield is attractive, it is only half the story, which brings us to the second metric. Technical metric: payout ratio. The second, and perhaps more crucial, metric is the payout ratio. This is calculated by dividing the total dividends paid by the company's net income. It assesses the sustainability of the dividend. A very high ratio, for instance, greater than 75%, means the company is paying out most of its profits, leaving less retained earnings for reinvestment or as a buffer during economic downturns. Summary for enthusiasts. To summarize our technical deep dive, remember that dividends are an equity reduction, not an expense. The ex-dividend date is your key eligibility checkpoint. And finally, when evaluating a company, always use a dual metric approach. Combine the attractive return offered by the yield with the critical sustainability check provided by the payout ratio. Questions. Thank you for joining this presentation on the technical aspects of stock market dividends. I'm now open to any questions you may have regarding dividend mechanics, accounting treatment, or the application of these key metrics. Thank you.